What if I told you that a security guard, a blackjack player, and a former pianist walked into a trading room and walked out as millionaires? This isn't a joke. It's one of the most incredible stories in Wall Street history, and it all started with a simple bet between two friends about whether great traders are born or made. The answer to that bet changed everything we thought we knew about trading success, and by the end of this video, it might just change your entire approach to the markets forever. Today, we're diving deep into the mindset and trading psychology of the man behind this legendary experiment, Richard Dennis, who is considered one of the greatest traders of all time. From mastering patience to understanding risk management, we'll uncover the 10 powerful principles that can elevate your trading game. So if you're looking to become a more disciplined and consistent trader, you're in the right place. Now, let's jump into the world of Richard Dennis and learn how to transform your trading mindset. Our first principle focuses on the revolutionary end game, changing idea that trading is actually something that can be taught to anyone, which is the core Richard Dennis belief that fundamentally changed how Wall Street thinks about successful trading. Imagine this scenario for a moment. You're a complete beginner with no fancy finance degree from an expensive university, no Wall Street background or connections, just a regular everyday person with simple curiosity about how the financial markets work. Now imagine becoming a millionaire trader, making more money than you ever dreamed possible, all because someone believed that trading skills could be taught to ordinary people just like learning to drive a car or play a musical instrument. That someone who believed this was Richard Dennis. Richard Dennis, who became famously known throughout the trading world as the Prince of the Pit, built an absolutely incredible trading fortune, starting with just $1,600 of his own money and eventually turning that small amount into over $200 million in profits. But it wasn't just his remarkable financial success that made him a true legend in the trading world and earned him respect from traders everywhere. It was his unwavering conviction and strong belief that trading wasn't some mysterious, mystical gift reserved only for the chosen few with special talents, but rather a practical skill that could be taught, practiced, and ultimately mastered just like any other discipline you might learn, whether that's cooking, carpentry, or playing sports. This powerful belief led to one of the most famous and influential experiments in financial history, which became known around the world as the turtle trading experiment. Dennis had an ongoing friendly debate and discussion with his business partner and fellow trader William Eckhart, where Eckhart strongly argued that great traders were born with natural talent and special abilities, not made through education and training. But Dennis thought completely otherwise, and firmly believed that if you gave someone a strong set of clear trading rules, taught them proper discipline and self-control, and helped them understand how to manage risk and protect their money, they could become consistently profitable traders who make money over time, regardless of their educational background, previous work experience, or whether they had ever traded before. So they decided to put this interesting theory to the ultimate test and see who was right. In 1983, Dennis ran an advertisement in major newspapers across the country with a simple and straightforward message. No prior trading experience required, no expensive Ivy League diploma needed, no special connections necessary, just a genuine willingness to learn and a strong belief in the trading system they would be taught. Thousands of people from all over the country applied for this unique and rare opportunity, and from that massive pool of applicants, Dennis carefully handpicked a small group of individuals who he thought had the right attitude and mindset. These people came from all walks of life and had completely different backgrounds. The group included a security guard who worked night shifts, a blackjack player who understood gambling and probabilities, a software engineer who worked with computers, and even a former pianist who had performed music professionally. These diverse individuals with their varied backgrounds came to be known as the Turtles, a name that would become famous in trading history. In just 2 short weeks of intensive training, Dennis taught them everything they needed to know using a clear and simple trend, following strategy that anyone could understand. He taught them how to properly manage risk and never lose more money than they could afford, how to size their trading positions appropriately based on their account size, how to exit losing trades quickly without hesitation or second guessing, and how to ride winning trades fearlessly until the trend clearly ended and it was time to get out. Then, in an amazing show of confidence in his teaching methods, He handed them real money, millions of dollars in actual trading capital, and let them trade with it in the real markets. The result was absolutely astounding and shocked the entire trading world. Over the next 4 years, these complete novice traders who had never traded before reportedly earned over $100 million in profits. The turtle experiment didn't just prove Dennis's point about trading being teachable. It completely revolutionized trading psychology and shattered the long-held myth and false belief that you needed a certain personality type, special genetic wiring, or natural-born talent to succeed in the financial markets. What you really needed was a proven trading system that worked, unwavering discipline to follow the rules even when it was difficult, emotional control to manage fear and greed, and above all, a teachable mindset that remained open to learning new things and making improvements. Richard Dennis taught us that great traders aren't born with magical instincts. They're trained to think logically, manage risk, and stick to a plan, even when emotions scream otherwise. The turtles weren't immune to fear or greed, but they were taught how to control those emotions with rules. That's the true power of a teachable trading approach. This principle is still alive today. Look around. So many successful traders start with zero experience. But what separates the winners isn't talent. It's their mindset, their commitment to learning, and their ability to follow rules under pressure. So if you've ever felt like trading is only for math wizards or economic geniuses, think again. Richard Dennis proved that anyone can learn to trade provided they respect the process. In his own words, "I always say you could publish trading rules in a newspaper and no one would follow them. The key is consistency and discipline." And there it is, the heartbeat of Dennis's philosophy. Trading is teachable, but only if you're humble enough to learn and disciplined enough to follow through. Now let's explore our second principle, which reveals how following trends became the simple rule that built Dennis's $200 million fortune. Picture yourself standing at the edge of a fast-moving river where you have two choices. You could try to swim against the current, fighting every wave and exhausting yourself, or you could hop into a raft, let the current guide you, and flow with power and ease. That's exactly how Richard Dennis viewed the markets, as powerful rivers of momentum where the smart trader learns how to ride the current rather than fight against it. Richard Dennis didn't become a legendary trader by trying to predict market tops and bottoms, nor did he rely on complex forecasts or gut feelings. Instead, he built his incredible fortune by doing one thing consistently and effectively, following trends. To Dennis, successful trading wasn't about being right about market direction. It was about recognizing when something was moving in a particular direction and having both the courage and discipline to jump on that wave and ride it. He believed that price doesn't lie. The trend is your friend until it clearly shows you it's over. So, what does it mean to follow a trend? At its core, it's simple. You buy when prices are going up. You sell when prices are going down. You don't argue with the market. You observe it, align with it, and let it work in your favor. You don't need to know why the market is trending. You only need to know that it is. This idea was at the heart of the turtle trading system. Richard Dennis taught his students to watch for breakouts when prices moved beyond recent highs or lows. These breakouts were signals that a new trend might be starting. The turtles didn't try to catch the beginning or the end. They just wanted the big, juicy middle part, that sweet zone where the trend is alive and strong. But here's the catch. Following trends sounds easy, but emotionally, it's not. Think about it. When a stock keeps climbing, there's always that voice in your head saying, "It's gone up too much. It's too late to buy." Or when it's falling, you hesitate to short it because you think it has to bounce back soon. That's where most traders fail. Not in their analysis, but in their psychology. Dennis understood this better than anyone. He trained his turtles to trust the process. Don't question it. Don't get clever. Just follow the trend. Manage your risk and let the market do the heavy lifting. And when the trend finally ends, that's okay. You'll take a small loss, exit, and wait for the next opportunity. Because in trend following, it's not about being right every time. It's about being right big when it matters. Most traders are obsessed with high win rates. Dennis wasn't. He accepted that many trades would lose money, but when trends emerged, and they always do, the winners were massive. That's what kept the entire system profitable. In fact, Dennis once said, "A good trend-following system will keep you in the market until there is evidence that the trend has changed." That's the key. Stay in the trade. Don't jump out because of fear. Don't second guess. Ride the wave until it breaks. Trend following isn't glamorous. It doesn't give you bragging rights for calling a market top, but it works because it aligns with the psychology of the market itself. People chase prices, momentum builds on momentum, and trends persist longer than most expect. So, the next time you're in the market, ask yourself, are you trying to outsmart the crowd, or are you smart enough to go with the crowd while it's moving? This brings us to our third crucial principle, which focuses on the painful but essential discipline of cutting losses quickly. Let's be completely honest here. Losing money in the markets hurts deeply. It stings your ego, triggers intense fear, and makes you question everything you thought you knew about trading. But here's the fundamental truth that separates successful traders from the rest. Losses are simply part of the game, and what separates the professionals from the amateurs is precisely how they handle those inevitable losses. Richard Dennis built his remarkable success not just by riding trends effectively, but by knowing exactly when to get out when things went wrong. His core philosophy was straightforward yet powerful. Cut your losses quickly before they grow teeth and become dangerous. Why was this so important to him? Because small losses are like small fires. You can stomp them out early, but if you hesitate, if you let emotions like hope or denial take over, that little fire becomes a raging inferno. And in the markets, that can mean the difference between survival and total wipeout. Dennis taught this lesson over and over to his turtle traders. He drilled it into them. You will take losses. Accept it. Expect it. But never let them become bigger than they need to be. It's not just about protecting your capital. It's about protecting your mindset. Think about what happens when you hold on to a losing trade, hoping it will turn around. You stop thinking clearly. You ignore your rules. You pray, bargain, hesitate, and before you know it, the loss has doubled, then tripled, and you're frozen. Dennis knew that hope is not a strategy. He understood that the market doesn't care what price you entered at or how much you need to break even. The market just moves, and it rewards those who are emotionally detached enough to act decisively when a trade goes wrong. That's why every trade in the turtle system had a built-in exit rule. It wasn't optional. The moment a trade hit its predetermined stop, loss, you got out, no questions asked. Even if it hurt, even if it bounced back right after. Because in the long run, sticking to your stop meant survival, and survival was the name of the game. Richard Dennis once said, "You should always know what you are going to do if things don't go your way." That's the essence of risk management. In other words, before you even enter a trade, you should already know your worst-case scenario and be fully prepared to accept it. That's not weakness, that's strength. Most traders struggle here. They treat losses like personal failures, like they've made a mistake. But Dennis saw it differently. A loss is not a failure. It's the cost of doing business. It's a fee you pay to participate in a game where the reward, when it comes, can be enormous. This mindset helps you stay calm. It helps you move on. And, most importantly, it keeps you in the game long enough to catch the big winners when they arrive. Dennis didn't aim for a perfect win rate. He was okay losing on 60% of his trades because the 40% that worked, when managed with discipline, made up for everything and more. But those wins were only possible because he never let his losers spiral out of control. So here's the takeaway. Don't fear losses. Fear ignoring them. Accept them fast. Cut them faster. Protect your capital like your life depends on it. Because in the world of trading, it does. The sooner you get comfortable with taking small losses, the sooner you'll start thinking like a real trader. And that's exactly what Richard Dennis wanted to teach. Trading isn't about being right all the time. It's about doing the right thing at the right time, especially when it hurts. Moving on to our fourth principle, we'll explore the courage required to let profits run, which means staying in a winning trade even when it becomes uncomfortable. In trading, we're often told the classic advice to cut your losses and let your winners run. While this sounds simple in theory, when you're actually in a profitable trade and watching the market tick up and down moment by moment, the overwhelming urge to grab those quick gains can become almost irresistible. That's where most traders fall short. But not Richard Dennis. He knew that letting profits run was the secret to catching those rare game-changing trades, the ones that could wipe out 10 small losses and still leave you way ahead. For Dennis, riding a trend wasn't just a strategy. It was a philosophy, a mindset. And it takes guts, because here's the hard truth. Letting a winner run goes against human nature. When we see green on our screen, we want to lock it in. It feels good. It's safe. But Dennis taught his turtles that trading isn't about feeling good. It's about following the process, even when it's uncomfortable. So, how did he do it? His system was built around trend following. And that means staying in a trade as long as the trend remains intact. No second-guessing, no profit targets, no "I've made enough" mentality. He'd enter when the trend began and only exit when the trend clearly ended. That takes discipline, patience, and serious emotional control. One of the most powerful things Dennis understood was this. Big moves don't happen every day, but when they do, you've got to be in them. You can't catch the 20% rally in crude oil or the 30% drop in gold if you jump out with a tiny gain. The market doesn't give out rewards for playing it safe. In fact, Dennis accepted that many trades would barely go anywhere or even lose money. But when a trade started to trend hard in his favor, that's when he did the hardest thing of all. Nothing. He just let the market keep paying him. Most traders struggle to sit still with a winning trade. But Dennis, he trained himself and his turtles to sit on their hands and let the trend do the work. One of his famous sayings was, "If you're making money, don't be in a hurry to stop. Let your profits run and only exit when there's a real reason, not just because you're nervous." It's also about compounding. A trade that starts with a small gain could explode into a massive winner over days or weeks if you can resist the temptation to cash out too early. Dennis's system used trailing stops to stay in as long as possible. He didn't try to guess the top. He waited until the trend clearly broke before exiting. This mindset requires emotional mastery because letting profits run means giving up control. You're trusting the market to keep rewarding you, and that can be scary. The bigger the profit gets, the more you fear losing it. But Dennis taught that fear should never make your trading decisions. Rules should. He once said, "The big money is made by the big move." That's the heart of this lesson. If you kill your trades too early, you'll never be around for that big move. And in trend following, the big move is everything. Next, let's dive into our fifth principle, which examines the systematic approach that formed the backbone of Dennis's trading genius. Imagine for a moment that you're standing in the middle of a chaotic marketplace where bells are ringing constantly, prices are flashing everywhere, traders are shouting orders, and emotions are flying high in every direction. Now imagine being completely calm, focused, and absolutely certain of your next move despite all this chaos. That's the incredible power of having a systematic approach to trading, and Richard Dennis believed in this concept with unwavering conviction. For Dennis, trading wasn't about instinct. It wasn't about guessing or reacting emotionally to every price tick. It was about following a clear, structured set of rules every single time. Why? Because he knew something most traders eventually learn the hard way. Human emotions are the enemy of consistent success. Fear, greed, doubt, overconfidence, they all creep in when decisions are made on the fly. But a system doesn't feel, it doesn't hesitate. It just follows the plan. Dennis's approach was rooted in logic and rules, not in hunches. Every entry, exit, position size, and stop loss was predefined. He didn't need to feel good about a trade to take it. If the setup matched the criteria, he acted without hesitation and without overthinking. This was the cornerstone of the turtle trading experiment. He took ordinary people, teachers, engineers, even a security guard, and turned them into successful traders. Not by sharing secrets, but by giving them a system. And what did that system do? It removed the guesswork. It told them when to trade, how much to risk, where to get out, and when to walk away. Now, why is this so powerful? Because in the heat of the moment, emotions can cloud judgment. The market can tempt you to break your rules, chase trades, or hold on to losers. But a systematic approach builds a wall between you and your impulses. It keeps you grounded. It keeps you honest. Dennis once said, "You have to minimize your reliance on emotion and base your decisions on a tested, repeatable process." He wasn't just teaching strategy. He was teaching mindset. He wanted his traders to trust the process more than they trusted their feelings. Because feelings can betray you, but a solid system grounded in data and experience rarely will. Think about it. When you follow a plan, your trading becomes repeatable, measurable, reviewable. You can learn, improve, and evolve. But when you're winging it every day, how do you even know what's working? Richard Dennis understood this better than anyone. He also knew that having a system doesn't mean you'll win every time. In fact, many trades will still be losers. But over time, a good system will prove itself through consistent execution and sound risk management. The key is to stick with it, especially when your emotions scream at you to do otherwise. Let's not forget, the market is unpredictable, but your behavior can be made consistent. That's where your real power lies. So, what did Dennis's systematic approach actually look like? It included clear entry signals, based on breakouts and trend movements, predefined stop, loss levels to cut losers quickly, position sizing rules based on volatility and account size, exit strategies using trailing stops to let winners run. And, most importantly, it was followed without hesitation. That's what made it powerful. Not the complexity, but the consistency. So if you want to trade like a pro, ask yourself, do you have a system? Do you trust it? Do you follow it no matter what? Because if the answer is yes, then you're already thinking like Richard Dennis. And that, my friend, is the beginning of real trading success. Our sixth principle emphasizes that risk management is absolutely crucial because it protects what matters most in trading, your capital. Let's be completely real about something. When most people think about successful traders, they usually picture big wins, huge profits, and fast-paced trades that generate excitement. But Richard Dennis knew something far more important. The real secret to long-term success wasn't in chasing gains, but rather in controlling losses with precision and discipline. At the core of his trading philosophy was this powerful truth: you're not in the game to make money. You're in the game to stay in the game. And that meant protecting your capital like your life depended on it. So, what did Dennis teach his turtles? And what can we learn from it today? First and foremost, Dennis emphasized position sizing. Not every trade deserves the same bet. He didn't believe in going all in or trading based on gut feeling. Instead, he used calculated risk, adjusting the size of each trade based on market volatility and the total value of the trading account. If the market was quiet and steady, the system might allow a slightly bigger position. But when volatility spiked, positions were reduced. This wasn't optional. It was part of the plan because volatility means uncertainty. And when the market gets wild, protecting your capital becomes priority number one. This wasn't just smart, it was survival. Dennis also believed that every single trade should be approached with a full awareness of the worst-case scenario. Before hitting buy, you had to know, how much am I willing to lose if this goes wrong? And if the potential loss was outside your comfort zone, you didn't take the trade, period. This is where most retail traders fail. They focus on potential rewards, but ignore potential risks. They dream of profits but forget the cost. Richard Dennis flipped that mindset. He taught his traders to always think defensively first, offensively second. And here's where emotions come into play again. Risk management isn't just numbers on a screen. It's about protecting your emotional stability. When your position is too big, every tick against you feels like a punch in the gut. You panic, you freeze, you make bad decisions. But when your risk is calculated and controlled, you stay calm. You follow your plan. You trade like a professional. Dennis once said, "You can be wrong half the time and still make a fortune if you manage risk properly." And that's powerful because the truth is, no trader wins all the time. Not even Dennis himself. But he didn't need to. His system was designed so that even with a modest win rate, he could still grow his capital because he kept losses small and survivable. Another key lesson: never risk everything on one trade. The turtles were taught to risk only a small percentage of their account on any single position, usually around 1 to 2%. This ensured that even a string of losses wouldn't destroy them emotionally or financially. That's the real power of risk management. It gives you longevity. It allows you to make mistakes, learn, adjust, and keep trading. Without it, even the best strategy can turn into disaster. So, if you're serious about trading success, remember this lesson from Richard Dennis. Winning is not about the big gains. It's about protecting yourself when things go wrong. Because the market will test you. It will turn against you. And when it does, your risk plan is your only shield. And that's what separates the dreamers from the doers. Now we come to our seventh principle, which reveals why discipline must always triumph over emotion, forming the backbone of true trading mastery. In the world of trading, there's a silent war happening every single day between two powerful forces, discipline and emotion. Richard Dennis understood this internal battle better than anyone and believed that even the best strategy in the world was completely useless without the discipline to follow it consistently. You see, it's easy to stick to your plan when things are calm, when the market moves just as you expected, when your trades are going green. But what happens when the market turns against you? When fear kicks in? When you're tempted to break your own rules? That's where discipline becomes everything. Richard Dennis taught his turtles this critical truth. Your biggest enemy isn't the market, it's your own mind. Trading triggers emotions, fear, greed, hope, doubt. And if you don't control them, they will control you. One impulsive decision can wipe out weeks or months of steady gains. And that's why Dennis placed such a strong emphasis on emotional discipline. He didn't just give his traders a system. He gave them structure, rules, boundaries, not to restrict them, but to protect them from themselves. Discipline means entering a trade when your setup appears, even if your gut says, maybe wait. Discipline means holding your position when the trend is strong, even if you're scared it might reverse. And yes, discipline means taking a loss when your stop is hit, even when your ego screams, wait, it might come back. This is where most traders fail. Not because they don't know what to do, but because they don't do what they know. Dennis believed trading was mostly psychological. In fact, during the turtle experiment, he quickly noticed something interesting. The ones who succeeded weren't necessarily the smartest. They were the most disciplined. They didn't argue with the system. They didn't let fear stop them from entering. And they didn't let greed convince them to break rules. They followed the plan. Dennis once said, "A good system is one that you can follow with discipline, not just when it's working, but when it's not." Because here's the harsh truth. Even a great system will go through losing streaks. That's just part of the game. The question is, will you stick with it when the wins disappear for a while, or will you start tweaking, guessing, and abandoning your edge? Discipline is what keeps you from unraveling during tough times. And it's not just about resisting fear. It's also about managing overconfidence. After a big win, many traders start to feel invincible. They take bigger risks, bend rules, ignore their stops. Dennis warned against this mindset, reminding his traders that the moment you feel above the rules is the moment the market will humble you. So, how do you build this kind of discipline? Start with routine. Trade at the same time. Review your rules daily. Track your trades religiously. Don't just plan your trades. Practice sticking to the plan. And most importantly, accept that emotion will always be there, but it doesn't have to be in control. Dennis wasn't robotic. He had feelings like everyone else, but he trained himself and his turtles to let the system lead, not emotion. Because in the end, discipline is the bridge between knowing and doing, and in the world of trading, doing the right thing consistently is the only path to long-term success. So the next time the market tempts you to break your rules, ask yourself, are you reacting or are you staying disciplined? Like Dennis taught, the answer might just define your trading future. Our eighth principle demonstrates that consistency is the key to unlocking the power of long-term commitment in trading. In today's fast-paced trading world, it's incredibly easy to get distracted by the allure of quick wins, the desire to cash in on fast profits, or the temptation to make a big splash with a single trade. But Richard Dennis understood a fundamental truth that most traders completely miss. Consistency is far more powerful than any short-term wins could ever be. Dennis didn't believe in chasing the market or trying to time every little movement. Instead, he focused on consistent application of a well-tested strategy over time. The key wasn't to hit it big with one lucky trade. No, the key was to show up, follow the plan, and execute the strategy day after day, even when the results didn't immediately show up. Why was consistency so important? Because trading is a marathon, not a sprint. The market doesn't reward impatience or short-term thinking. Sure, you might get lucky once or twice, but relying on luck is a dangerous game. Consistency, on the other hand, is built on discipline, patience, and sticking to your edge even when things aren't going your way. Dennis knew that over time, if you kept following the strategy and managing your risk properly, the results would come. They might not come immediately, and they might not come in a straight line. There will be bumps. There will be drawdowns. But consistently applying the plan would eventually lead to positive results. This wasn't just about being safe. It was about being smart. Think of trading like planting seeds. You don't expect to harvest tomorrow, but if you water and nurture those seeds consistently, they'll grow into something meaningful over time. Dennis applied this principle to his own trading and to the turtles. He showed them that while some trades might feel like setbacks in the short run, staying consistent would ensure long-term growth. This philosophy was embedded in the way Dennis structured his trading system. Every decision, every rule was designed for long-term consistency. The goal wasn't to outsmart the market with one brilliant move. It was to be in the market executing the plan, taking small risks over and over, and allowing those small wins to compound over time. Dennis also understood something crucial. The market doesn't reward impatience. So often, traders are driven by the urge to make up for lost time after a losing streak. This leads them to take unnecessary risks or break their own rules. But Dennis's approach kept him grounded. He knew that every trader would face losses and that the key wasn't to avoid them, but to stay consistent through them. This idea of consistency also ties into his belief in process over outcome. The outcome, whether you win or lose, is out of your control. The only thing you can control is the process. Executing your strategy with consistency no matter what the market does. By focusing on the process, you're taking control of your trading destiny. Dennis would often tell his turtles that the best traders aren't the ones who get lucky with a few big wins. They're the ones who focus on executing a consistent plan day after day, year after year. That's how you get real, sustainable results in the markets. So, if you want to achieve trading success, you need to ask yourself, are you willing to be consistent even when it feels like the market is testing you? Are you ready to trust your system and focus on long-term growth rather than short-term gratification? Because the truth is, consistency doesn't always feel exciting. It doesn't offer instant rewards. But when you commit to it, when you consistently apply your strategy, trust your system, and stay patient, you'll unlock the power of true trading mastery. Let's examine our ninth principle, which teaches us to avoid overtrading because patience truly pays off in the long run. In the world of trading, the temptation to constantly act can become completely overwhelming. The markets are always moving, always changing, and it's incredibly easy to feel like you should be actively participating in the action all the time. However, here's a crucial truth that many traders learn the hard way. More trades definitely don't mean more profits, and in fact, excessive trading often leads to more losses than gains. Dennis strongly cautioned against overtrading, and for good reason. The core of his advice was simple. Don't trade just for the sake of trading. In fact, one of the biggest mistakes you can make as a trader is to jump into a trade simply because you feel like you should be doing something. If the setup doesn't align with your strategy, stay out. You see, trading is a lot like fishing. You don't catch fish every time you throw your line in. Sometimes you wait for hours without a bite, but when you do feel that pull on the line, when the setup is perfect, that's when you strike. This principle was foundational in Dennis's system. He emphasized that successful traders wait for the highest probability setups, not just any trade that pops up. The key was to be patient and wait for the market to give you an opportunity that matches your criteria. It wasn't about chasing the market or forcing a trade. It was about recognizing when the conditions were just right and acting on it decisively. Overtrading, Dennis warned, doesn't just hurt your wallet, it hurts your mindset. When you trade too often, you risk getting caught up in the noise of the market. You start reacting to every little price movement, letting your emotions take over. Instead of sticking to your plan, you're driven by fear of missing out or by a need to make up for losses. This leads to impulsive decisions and poor risk management. And that's where the real damage happens. Dennis's system was designed to avoid this very pitfall. His traders, the turtles, were taught to take high-probability trades based on, well, defined entry and exit rules. If the setup didn't meet the criteria, no trade. If the market conditions weren't right, stay on the sidelines. This discipline ensured they weren't trading out of boredom or emotion. They were trading because the market was presenting them with an opportunity they knew was worth taking. So, how do you avoid overtrading? First, stick to your system. If the trade doesn't fit your strategy, don't take it, no matter how tempting. Second, be patient. Don't force trades. Let the market come to you. Trust that opportunities will present themselves when the time is right. Third, stay emotionally balanced. Overtrading is often driven by emotional impulses, fear, greed, or excitement. Recognize these feelings and take a step back. Trading is a marathon, not a sprint. Dennis's advice on overtrading was about creating a mindset of calm and control. Trading isn't a race. You don't need to make a move every day. You only need to make the right move when the conditions align with your system. And remember, every trade carries a risk. So, if you're taking too many trades, especially low-quality ones, you're not only increasing your chances of losses, you're also wasting precious capital. Every unnecessary trade chips away at your trading account, your confidence, and your focus. Richard Dennis was clear about one thing. The best traders aren't those who trade the most. They're the ones who are selective and patient. They wait for the right setup, execute with precision, and then let the market unfold. This principle goes hand in hand with risk management. By avoiding overtrading, you're naturally managing your risk more effectively. Instead of throwing money at every trade, you're taking a strategic, calculated approach to each opportunity that presents itself. So the next time you feel the urge to make a trade, ask yourself, is this trade in line with my strategy? Does it fit my high-probability setup? Am I acting out of impulse, or am I following my plan? If you can answer these questions honestly and consistently, you're already on your way to trading with the kind of discipline Richard Dennis championed. Finally, let's explore our 10th and final principle, which emphasizes the importance of continuous learning and evolving with the market. Richard Dennis, despite being one of the most successful traders of his time, never stopped learning and growing as a trader. This represents one of the most powerful lessons he imparted to his turtles and to all traders who would listen. In an industry as dynamic and ever changing as the financial markets, resting on your laurels is never an option because the market constantly evolves, and so should you. Dennis believed that no matter how successful a trader becomes, there's always something new to learn. This wasn't just about gaining knowledge. It was about staying adaptive. The markets change. What worked yesterday might not work tomorrow. And that's why continuous learning is essential. Now, let's talk about what this means practically. First, and most importantly, you need to stay curious. Dennis always emphasized the importance of curiosity. If you want to succeed in trading, you can't just blindly follow rules or strategies. You need to understand why something works and how the market moves. Curiosity pushes you to keep questioning and improving, to ask, what could I be missing and how can I make this better? This mindset allows you to embrace new ideas and refine your strategies based on what's working in the current market. As a trader, it's not enough to learn something once and call it done. You must constantly challenge yourself to improve and grow. The turtle traders weren't just blindly following a set system without thinking. They were actually encouraged to keep improving their trading skills as they gained more experience. and to make changes based on what they learned from their own real trading situations. In the world of trading, learning from books and theories is certainly important, but nothing beats the lessons you learn from actually being in the market and experiencing it firsthand. Third, you must learn to adapt and adjust to changing market conditions. Dennis understood that the financial market is never exactly the same from one day to the next, or from one month to the next. There are periods of time when stock prices go up consistently for months at a time, and we call these bull markets because prices are charging upward like a bull. There are also times when prices fall consistently for months, and we call these bear markets because prices are swiping downward like a bear's claw. Sometimes the market moves wildly up and down in short periods of time, which we call volatile periods, because prices are unpredictable and jumpy. And sometimes the market stays relatively calm and steady, moving slowly in one direction without big swings. Here's the important point. A trading strategy that works really well when the market is steadily going up might not work at all when the market is steadily going down. The key to long-term success, according to Dennis, is being able to recognize these different market conditions and adapt your trading approach based on what the market is actually doing right now, not what you think it should be doing. Don't become so emotionally attached to one particular trading system that you refuse to see the warning signs when it's not working anymore. If your trading strategy isn't making money like it used to, or if you're experiencing more losses than usual, it's time to step back from the day to day trading, take an honest look at what's changed in the market, and adjust your approach accordingly. The best and most successful traders in the world are the ones who can recognize when the market environment is shifting and changing, and they're willing to evolve and modify their trading methods along with those changes. Whether that means learning completely new trading techniques, using new computer software and technology tools, or making small but important adjustments to strategies they've used for years, this ability to adapt and change with the market is what keeps successful traders making money in a market that's constantly shifting and moving in new directions. Fourth, you must always stay humble and keep an open mind about learning new things, no matter how successful you become. Continuous learning also means staying humble about what you know and what you don't know about the markets. Even Richard Dennis, with all his incredible success and his ability to turn $1,600 into over $200 million, never assumed he had figured everything out or that he knew all there was to know about trading. Every single market environment he encountered, whether it was a strong bull market, a devastating bear market, or a confusing sideways market, offered him something new to discover and learn from. Even when he was at the absolute peak of his success and making millions of dollars, he was constantly asking questions about why things worked the way they did, making adjustments to his trading approach, and evolving his understanding of how financial markets actually operate. It's very easy to think you've figured out the secret to trading success, especially after you've had a series of profitable trades that make you feel like a genius. But as Dennis taught through his words and actions, the moment you stop learning and start thinking you know everything is the exact moment the market will teach you a very expensive lesson and humble you in ways you never expected. Always be willing to admit when you don't know something or when you've made a mistake, and be ready to embrace new information and ideas, even if they challenge what you previously believed to be true. Finally, you must actively invest time, energy, and resources in your own growth and development as a trader. Dennis's commitment to continuous learning went far beyond just reading trading books or attending weekend seminars about market analysis. It was about making a serious investment in your growth as a trader, both intellectually and practically. Whether that meant hiring experienced mentors who could guide his thinking, spending hours doing deep analysis of market data to understand patterns, or experimenting with new trading strategies in small amounts to test their effectiveness, he understood that lasting success didn't come from a single moment of brilliant insight. Instead, it came from constant, never-ending growth and improvement over many years of dedicated effort. So, how do you apply this important principle to your own trading journey? It's actually quite simple in concept, though it requires discipline to execute. Never stop learning, no matter how much experience you gain or how successful you become. Whether you're learning from analyzing your own winning and losing trades, studying how the market behaves in different conditions, seeking guidance from experienced mentors and successful traders, or learning from other traders who have different approaches than your own. Always keep working to improve your understanding and skills. The more you learn and the more knowledge you acquire, the more adaptable and flexible you become as a trader, and the better prepared you are for whatever unexpected situations the market might throw your way. Richard Dennis's approach to continuous learning serves as a powerful reminder that in the fast-moving world of financial trading, education is not something you complete once and then forget about. Instead, it's an ongoing journey that lasts throughout your entire trading career. By staying curious about how markets work, staying adaptable to changing conditions, staying humble about your limitations, and remaining open to new ideas and approaches, you ensure that you are always improving and growing as a trader. And that continuous growth and improvement, in turn, helps you stay one step ahead of the market and maintain your edge over other traders who might become complacent or stop learning. And there you have it. 10 powerful and proven principles from one of the greatest traders in financial history. I sincerely hope these valuable lessons from Richard Dennis will inspire you to completely transform your own approach to trading and help you develop the mindset of a consistently profitable trader. If you found this content valuable and helpful, please take a moment to like this video, share it with fellow traders who might benefit from these insights, and subscribe to Trading Psychology Shift for more in-depth trading education and psychological insights. I'd love to hear from you in the comments section below, so please let me know which of these 10 principles resonated most strongly with you and how you plan to apply them to your own trading journey. Thanks for watching, and here's to your success and happy trading.